Hello and welcome. In this video, we are looking at how to account for lease in lessee's accounts according to IFRS 16 leases. We have two questions. In the first question, we are assuming that the lease rentals are paid in arrears, means at the end of the year. And in the other question, we are assuming that the lease rentals are paid in advance. Both questions can be found in the video description. Get those questions, paste them in a blank Excel document, and then work through those with me. First question, where we have lease payments are in arrears. Tumba PLC leased the machine on 1st January 2019 for 5 years. The life of the machine is 15 years. Tumba will pay annual lease rental of 30,000 in arrears for 5 years. The present value of lease payments is 129,884. Interest rate implicit in the lease contract is 5%. Show accounting entries in Tumba PLC's financial statements for the year ended 31st December 2019. So assume that you are preparing financial statements for this company at 31st December 2019. What items related to this lease are you going to include in those financial statements? According to IFRS 16, when lessee enters into a lease contract, there is a leased asset, which is called right to use asset, and there is a lease liability. Okay, so as soon as lessee enters into the contract, both are recognized, right to use asset and the liability. Okay, and at the year end, they are measured differently and recorded in the financial statement. So that's what we need to do. Okay, so first of all, we are going to measure the right to use asset, then we'll measure the liability, and then we will show them in the financial statements. Okay, let's start with the asset then. So let's do small workings. First of all, right to use asset working. Okay, so how are you going to measure this asset at 31st December 2019? So initially, when lessee enters into the contract, the right to use asset is measured at present value of the lease payments. In this case, it is 129,884. Plus, lessee is going to add any additional directly attributable costs to the asset. So, for example, in order to install this machine, if lessee has to pay money to people who are installing the machine, or Tumba needs to clear the site to install the machine, those are the directly attributable costs. If those are given, we need to add those to the cost of an asset. In this case, there are none. So we are going to recognize initially the right to use asset at the present value of future lease payments, 129,884. Okay, at the start on 1st of January 2019, when the lease contract was drawn. Then the depreciation for the year. So if we want to measure this asset at the year end, we need to depreciate it according to IFRS 16. Okay, and IFRS 16 says that the depreciation should be charged to the time period, over the time period which is shorter, okay, of the lease payment and the life of the asset. So for lessee, actually the lease period is 5 years. So technically, to lessee, the economic useful life of right to use asset is just 5 years. And that is shorter than 15 years life. Okay, so we're going to depreciate it over 5 years. So let's depreciate it over 5 years. Okay, and this depreciation will go to P&L. When you're preparing financial statement, you need to take this depreciation to P&L. And when you remove the depreciation, the carrying value of the machine becomes this much. And we'll take carrying value to SFP, as you know it. Okay, now let's talk about the lease liability, okay, on 31st December 2019. So this is our second working, lease liability. Now the issue of payment in arrears or in advance comes into the picture. Okay, so, right, sorry about that. When the payments are made in arrears, okay, then we should charge the interest on the outstanding amount before removing the lease rental from the total amount, which includes the outstanding amount plus the interest. What do I mean by that? Okay, so the simplest way to measure the lease liability is to lay it out in a nice table like this. Sorry, didn't work. Let's try it again. So yeah, this is our table, and the table has the year that in which we are trying to measure the liability. We'll have an opening balance of liability. We will charge interest on the opening liability then. Okay, so in this case, the interest rate implicit in the lease is 5%. So we're going to be charging interest at 5%. And that's what I meant by when I said that we need to charge interest on the opening balance first and then remove the lease rental. Okay, so the fourth column is, you can't say it, the fourth column is subtotal. So opening balance plus finance costs, when you add them up, you get subtotal minus lease rental, and that will give you closing balance. So lease rental is where you it's something similar to paying the mortgage installment, and in each installment you are paying some of the interest and some capital back. So in this case, when we pay £30,000, when Tumba pays £30,000, the £30,000 includes bit of interest and bit of capital repayment. Okay, and if it keeps doing that for 5 years, at the end of the 5th year, all the liability will be gone because it will have settled everything. Okay, so when you remove lease rental, you will be left with closing balance. So let's start with 2019. Okay, so in 2019, our opening balance, as you know, is 129,884. So we entered into the lease contract at the start of the year. Then we charge interest at 5% on that. So the interest becomes this much. Subtotal of interest and opening balance is this much. Then the lease rental of 30,000 is removed from the subtotal. Okay, and the closing balance is this much, you can see. So let's understand what is happening. At the start of the year 2019, the opening balance was 129,884. Then that remained outstanding up until end of the year. So we need to charge 5% interest on the outstanding balance, okay, because we have incurred the interest. So altogether at the year end, our liability was 136,378. Then we settled 30,000 from it, and our closing balance therefore became 106,378. So this is our total lease liability at the end of 2019. All right. So if I'm preparing financial statement, this is the amount I need to show. But what we do need to do is to split this liability into non-current and current liability. Okay, so what are we going to do? In order to do that, we need to carry on for one more step in this table. So we will do it the same process for 2020, the following year. So our opening liability is actually last year's closing. Then we charge finance cost on that, then subtotal, remove lease rental, and closing liability is this much. So whatever you are not settling in the following year, so our current year is 2019, right? 2019. So out of 106,378, what we are not paying in the following year in 2020 is 81,697. And because it did not settle within 1 year period, this liability, it becomes the non-current liability. Okay, it becomes the non-current lease liability. Then what is the current liability? The current liability will be the difference between this and this. So whatever you settle in the second year, all right, whatever outstanding capital amount which you owed, you settle in the second year, which is the difference between these two figures, becomes the current liability. Does that make sense? So one more time, when the payments are in arrears, this is how you lay out the table. Year, then opening balance, then immediately after that, include the finance cost column, then subtotal column, then lease rental, and that's how you're going to get the closing balance. And then you do the working for 2 years. Why? Because you want the second year, the following year's closing lease liability, and that becomes your non-current liability for the first year because you are not settling it in the second year. And the difference between the closing balances of first and second year becomes your current liability. Make sense? And from this table, the finance cost for 2019 also needs to go to P&L. Okay, so now let's show P&L. Statement of profit or loss for the year ended 31st December 2019. Okay, so the first thing I'm going to charge as part of operating cost is this depreciation charge. Okay, and that is this figure here. Yeah, we said earlier on depreciation goes in P&L, and the second thing that will go, okay, after depreciation charge. So probably before the finance cost from the table, you will have the operating profit here. If you're preparing the whole financial statement, so I'll have an operating profit here. And once I have recorded operating profit, then I will do the finance cost. Okay, and the finance cost, according to our table, is this much. Make sense? Okay, now what? Statement of financial position. Okay, statement of financial position for the year ended 31st December 2019. Now in this financial statement, we'll have a non-current asset, which is right to use asset. Okay, right to use asset. Let's write it here. This is the carrying value that we worked out in the first working, and the carrying value in the first working was this much. Yeah. Then non-current liabilities, and in non-current liability you have a lease liability. Okay, the closing balance of the second year, that is your non-current liability. And then what about the current liability? Lease liability. The current liability is, as we say, the difference between the closing balances from the table for the first year and the second year. Okay, so that's what I've shown in the brackets here, and that is the difference that we worked out. Make sense? So we have prepared these extracts from the financial statements, but if you are in exam and preparing the whole financial statements, these items will go in below financial statements, as you can see on the screen. Okay, so this was the question on arrears, lease rental in arrears, where the payments are made at the end of the year. Now let's see what happens if the payments are made in advance at the start of the year, right? So in this case, most of the information given is the same, except for, let's read through it. So we know Tumba PLC leased the machine on 1st January, 5 years, life of the machine 15 years. Tumba will pay annual lease rental of 30,000, but in advance for 5 years. The present value of lease payments is different because it is paid in advance. Interest rate implicit in the lease contract is 5%. That is not changed, and we need to show the figures in the financial statements. Okay, so let's begin. The way we measure the asset, okay, the right to use asset, is not going to be any different. Okay, so it's going to be the same. So the cost is the present value of future lease payment. In this case, is this much. Depreciation is over 5 years. Okay, and carrying value. Okay, now how about the lease liability then? Now please note that in this case we are making payment in advance. Okay, so every time you make the payment, the liability goes down, and therefore when you charge interest, you have to charge interest on that smaller amount. And for that reason, we are going to lay out the table slightly differently. Okay, now let's have a look. How are we going to do that? So can you spot the obvious difference here? So we have here, we have opening balance, and instead of the finance cost, we have a lease rental. Okay, and finance cost is added after you have worked out the subtotal. That will give you the closing balance, right? So what is happening is, when we start with our opening balance of lease liability, because we are making payments in advance, so immediately we enter into the lease agreement, we make a payment of 30,000. Okay, so immediately our total balance of 136,379 goes down by 30,000. And so when we need to charge the interest, we will charge the interest on a smaller amount, okay, and to get our closing balance. Let's see how it works. So 2019, okay, opening balance in 2019, as we know, 136,379. Then immediately after that is a lease rental, 30,000. We are paying it on the 1st January. So the subtotal, when you remove that, becomes smaller. Okay, in the previous example, the subtotal became bigger because we added interest to that. Then the finance cost at 5% on the subtotal, so we have charged 5% on this figure. Okay, and therefore the interest, you can see, compared to the previous question, interest was higher, or the finance cost was higher. In this case, is lower, and that's how we get the closing balance. Okay, let's make it slightly bigger so you can see. Now, similar to the previous question, we should continue for one more year. Okay, so 2020, but we don't need to complete whole of 2020. I'll show you why in a minute. Okay, the opening balance is last year's closing balance, then you pay lease rental. Okay, and that's how you get the subtotal. Right, so this is it up to the subtotal. And the reason is, out of the total 111,698 worth of closing liability, okay, whatever we are not settling next year is this amount. Okay, so we are paying 30,000 immediately at the start of 2020, right? So we have paid. What we haven't paid is this much. All right, so for that reason, this becomes our non-current liability. We should not add the finance cost and then work out the closing balance and then take the difference to decide what the current liability is, because next year's interest hasn't accrued yet. Okay, which means that theoretically, if at the start of next year, if we settle the whole lease outstanding amount, there won't be any interest next year. All right, so when I want to work out the liability for the next year, which I'm settling in next year, I shouldn't include the interest in that. And for that reason, we stop at the subtotal and say this, the subtotal, is our non-current liability. Okay, and then what is the current liability then? Then the current liability is the lease rental for next year. Because you are paying lease rental in advance, it does not include the interest for the following year. Okay, so we remove it immediately the second year starts, and therefore it is purely capital repayment. Okay, so that's why our current liability is this much, which excludes interest, and our non-current liability is this for the next year. Okay, so let's start with the statement of profit or loss. Okay, so starting with depreciation, which is this much, then operating profit, okay, and then finance cost, for 2019, which we worked out to be 5,319. Then statement of financial position, right to use asset, carrying value, which we worked out in working one. Okay, this is the carrying value, so let's put in the brackets is CV. Then non-current liability for the lease, and as we say, the non-current liability for our 2019 is the subtotal for the following year. Okay, oops, sorry, not there. That, and for that reason, now the current liability is 30,000. Let me just write it. Oops, didn't give me the pound sign, so I'm just going to copy and paste it from here. Make sense? So the key differences between payment in arrears and payment in advance is the way you lay out the table. Okay, for the lease liability, if it is in advance, then year opening balance, straight after that lease rental, then subtotal, then finance cost, and then closing balance. Okay, and in this case, when you want to split the liability into non-current and current, the non-current liability is the following year subtotal, and current liability is the lease rental that you pay next year. If the payments are in arrears at the end of the year, then the table is year opening balance, straight after that finance cost, because the opening balance was outstanding for the entire year, so you have to charge interest on that balance for the whole year. Then you add them up through subtotal, then you pay lease rental. So in this case, the lease rental includes the capital repayment and interest, and that's how you get the closing balance. Okay, and how are we splitting non-current and current liability in this one? We carry on for one more year, and following year's closing balance becomes non-current liability, and the difference between the difference between closing liabilities for the first year and the second year becomes the current liability, because that's what you are settling in the following year. Okay, so I hope you understand this issue, and please try these questions one more time and practice more questions to get your head around it. Thank you for watching.